March 23, 2026. Traditional market supports are fracturing under an immense invisible downward pressure. Today, we are analyzing the structural options flow data for two major indices, SPXW and NDXP. Both assets are trapped deep in a negative gamma regime. Gamma is a metric that measures the rate of change in an options delta, and in a negative regime, market makers are net short options. This chart shows the full chain gamma exposure, or X, profile for SPXW. The massive red area descending below the zero line represents a spot GEX deficit of negative $75.15 billion per 1% move. Shifting to the NDXP chart, we see a similarly dominant red structural deficit below its spot price, carrying a spot GEX of negative $2.61 billion per 1% move. The mechanical consequence of this severe deficit is that dealer delta hedging is strictly pro-cyclical. Delta measures how much an options price is expected to move for every $1 change in the underlying asset. To remain market neutral, dealers are forced to sell the underlying asset as prices fall and buy as they rise. They are actively amplifying every downward tick rather than absorbing the shock. Traditional fundamental analysis offers no edge today. Precise structural options thresholds will mechanically dictate all intraday price action. To understand how far the market is from safety, we have to look at the gamma flip. This is the specific price node that separates volatile negative gamma conditions from stable positive gamma flows. On this SPXW chart, the gamma flip sits high above the market at 6,736.49. The distance between the current spot line at 6,506.48 and this flip line represents the gap to flip. SPXW requires a massive 3.4% rally to reach stabilizing positive flows. NDXP faces a similar upward climb, with its structural flip zone firmly planted at 24,293.12. For NDXP, the gap to flip requires a 1.6% upward move to reach its regime pivot. Until these specific gaps are closed, every 1% directional move triggers amplified, aggressive dealer hedging in the exact same direction. Because stabilizing gamma is so far away, the market is effectively trapped in a hostile, high-volatility arena for the entire trading session. With overhead resistance miles away, the downside is defined by the gravitational pull of put walls, acting as structural floors of the daily session. The dominant SPXW put wall is located at 6,400, holding back a concentrated negative $5.69 billion in gamma exposure. Meanwhile, the dominant NDXP put wall sits at 24,000, bracing against negative $554 million. Based on the session range estimate, the indices historically close inside the boundaries of these put walls and the nearest positive call nodes roughly 78% of the time. However, an immediate threat overrides this baseline stability, the gamma cliff. The steepest drop in gamma occurs exactly at 0.0% below the current spot price for both assets, at 6,506 for SPXW and 23,898 for NDXP. At these specific gamma cliffs, near-the-money gamma concentration is hypercharged, meaning traditional technical support levels are frequently and violently overrun. The market is balancing directly on a trapdoor. A single downward break here triggers a mechanical, accelerating sell-off. If that trapdoor opens, we enter a break cascade sequence. If the 6,400 wall breaks on SPXW, it triggers forced dealer selling that feeds directly into the 6,500 level and then down to 6,300. The exact domino sequence for NDXP starts with a break at 24,000, triggering forced selling that pushes the price to 23,000, and then violently to 23,200. This cascade is immediately accelerated by the first compounding second-order Greek, Vanna, specifically bearish Vanna pressure. The Vanna mechanic dictates that as spot prices fall, implied volatility, or IV, naturally rises. Implied volatility captures the market's forecast of a likely price movement. This rising IV causes put deltas to climb even faster, forcing dealers to sell increasingly larger volumes of the underlying asset to stay delta neutral. The second compounding force acting on the cascade is speed, which measures the rate of gamma acceleration. Speed mathematically peaks dangerously near the max gamma pin strikes of 6,400 and 24,000. This creates a terminal feedback loop where dealers must aggressively accelerate their hedging precisely when the gamma itself is changing at its absolute fastest rate. Vanna and speed guarantee that a break of the cliff will not result in a linear drop. It will be a mathematically forced exponential acceleration straight into the underlying put walls. While these full chain mechanics set the macro stage, we have to account for the localized distortion of 0 days to expiration, or 0 DTE options. These same-day contracts create their own gravitational centers that can entirely override macro flows. For SPXW, the structural influence of these short-term options is relatively minor, with 0 DTE making up only about 9% of the total chain gamma. This chart shows the nearest expiry deep dive for NDXP. Looking at the share of total metric, we see a stark contrast. 0 DTE options contribute a massive 29% of the total chain gamma. This is a chart of the localized 0 DTE GEX profile for NDXP. This heavy concentration violently shifts the intraday target, dragging the NDXP pin from the full chain level of 24,000 all the way down to this sharp, deep expiry-specific put wall at 23,680. The dominant market maker force acting on this 0 DTE flow is charm. Charm measures the effect of time passing on an options delta. In the final 2 hours of the session, the minute-by-minute delta decay on out-of-the-money puts forces dealers to rapidly cover their short hedges. The interplay of this charm bid and the localized 0 DTE pin overrides all other macroeconomic data, creating a severe mechanical price compression in the afternoon. Traders on March 23, 2026, are facing a dual reality. The SPXW profile is heavily put-dominated, pinned tightly to the 6,400 structural level, and crushed by a negative $75 billion spot JEX deficit. NDXP is heavily distorted by its 29. Both assets are currently teetering exactly on a 0.0% gamma cliff, sitting just one tick away from a structural break. Navigating this specific environment requires abandoning traditional technical charting and completely surrendering to the dealer math. In a negative gamma trap, market makers do not provide liquidity. They actively hunt momentum, amplifying every directional move. The vast mathematical gaps to the positive gamma flips confirm that there is no systemic rescue coming today. Knowing the exact strike levels of the break cascade sequences is the only reliable way to anticipate the ensuing intraday violence. Precision risk management around these specific GEX nodes is the ultimate and perhaps only source of alpha in a purely pro-cyclical market.